Let's get started with the second panel discussion, which is going to focus on the responses from regulators to insure tech applications. This panel is going to be moderated by Stephanie Zinsmeyer, who's project manager at Access to Insurance Initiative. And I'm going to hand over to Stephanie to introduce the panel and the session. And there we go.
So the topic of the Consultative Forum is InsurTech rising to the regulatory challenge. So while we have heard in the past panel about the opportunities that InsurTech applications are providing and really some innovative examples, we now want to look at the regulatory side of it. So we have heard that InsurTech is moving at a speed of 150 kilometers per hour, so it's not easy to keep up that speed as a regulator. And what we want to discuss in this panel is what do these new digital technologies mean for regulatory frameworks? What risks might also be come up? And how can supervisors really strike a balance between facilitating innovation on the one side, but also taking care of the customer and protecting customers on the other side? As Hannah said in the beginning, as A2RI, we have done some work on mobile insurance, so mobile phone technology, and in the last year, and really looked at the challenges and opportunities that creates. And what we have found there, and I think what is applicable also to other digital technologies, is really the flexibility and regulation that is needed to facilitate that. But there are so many issues still that we didn't find a full answer yet that I would also like to discuss with the panelists later. So really the question of how to supervise new actors in the value chain, be it mobile network operators or insurtech companies or the big technology firms. How new digital technologies cut across multiple laws. So it was mentioned by Munida before that they are at AXA really working together with the telco regulator, with the banking supervisor and the insurance supervisor. So really to look at the role that the insurance supervisor is playing. How to ensure the appropriate use and privacy of customer data. And a question to regulators is really how to define the aspects of the business model in regulation. So for that, I have a nice panel here for you. Peter van der Brugge from the IAIS has already been introduced. Let me just add that Peter is also within the IAIS taking care of two IAIS or more IAIS working groups, but specifically those ones on InsurTech and FinTech. So Peter can tell you a bit about that. And Arup Chatterjee has also been introduced before. And let me just add that Arup is quite busy also writing blogs about FinTech. So he should give us, he should be able to give us some insights from the FinTech sphere as well. And then with us, we also have Yajnapriya Bharat from India, from IRD India. She's Chief General Manager at IRDA and currently heading the non-life department. Earlier, she was in charge of the health insurance department, prior to which she headed the consumer affairs department. She has over 30 years of experience in the insurance sectors, and which includes industry experience of 18 years. So glad to have all that experience with us from the Indian context. And then we also have with us Sabahat Ulayin, who's working as Deputy Director with the Securities and Exchange Commission of Pakistan since the last 6 years. She holds an MBA from the Institute of Business Administration and also holds the Junior Associateship of the Institute of Banking in Pakistan and is recognized by the Chartered Banking Institute of the UK. To start and to set the scene, Peter will now present us the findings of a paper that the IAIS did on fintech developments in the insurance industry. Not specific to the developing and emerging market context, but I think the paper is really an interesting read, and we have copies outside, I think. Yeah, Peter, go ahead and...
Okay, well, thanks for the introduction. So I'll be talking about the report on fintech developments in the insurance industry that was released by the IAIS a year ago. And the reason for that was that at that time, the IAIS thought, well, it's getting so important what's happening, and there were other, well, financial sector standard setters active as well. Insurance traditionally lagging a bit behind, but it's not a race. It's not too bad to look what's happening and see how you can reply to that and see what's happening. But at that point, we thought, well, it's getting so important, we need to collectively see what is this, what's happening, what should we be doing. And that's when they set up a task force to prepare this report, which was released a year ago. And you may think, foremost, it was important to sort of let's identify what's happening in terms of these innovations. Which innovations are out there? What should we looking at? What are the drivers behind that, both on the demand and supply side? And what's happening in the insurtech or in the fintech landscape? And then let's based on that, come and have a look at the potential impacts to the insurance industry and the supervisory approach in response to that. And they've done that based on 3 scenarios, which we'll explain. But there was a dedicated task force set up for that, who consists of members from all our membership around the world, from Mexico, Denise Garcia, which I have to thank because she prepared the slides for me for an earlier presentation. I thought they were so good that let's use them as well. So special thanks to Denise, although she's not here, but recognition for that. She was part of the task force. The Federal Reserve from the US was part of the task force. Bank of England from the UK, France, the ACPR, Brazil, SUSEP, they were all part of the task force, and I supported that. They had a roundtable in October 2016 involving industry representatives, startups, incumbents, a lot of consultancy firms as well, because they keep very close track of what's happening in that area, so they have a rich source of information, in our opinion. And then we prepared a report, and the first report was an interim report where we said, well, these are the developments, this is what we see happening, and maybe we can identify 3 scenarios on the basis we do further analysis. That was approved, and then we finalized the report in February, and then it was published in March 2016. So why should we look at this report? But you could say it's already a year old, and for some of the elements of that report, indeed, that may be the case. If you look, there's a part on investments, which flags the 2016 investments in insurance tech startups. That may have changed, but and the landscape and the activities of the startups. But it's very much a document of high level, very generic, and as a process it can be very useful. The innovations we flagged are very much still out there, and the approach, while I look at what the 3 scenarios, they're still very much valid, and based on that look at the impact in various areas like competitiveness or consumer choice. As a method, is very good to follow what's happening and see if you can sort of mimic that at national level, domestic level, although you may have emphasis in different areas. So the report flags that. Innovations like digital platforms, Internet of Things, telematics, use of big data, machine learning, artificial intelligence, distributed ledger technology, and blockchains. And then the group decided to go for 3 possible scenarios for the future, and then identify what the impact would be. The first scenario is very much things stay unchanged. The incumbents very much maintain the customer relationship. They partner with startups with innovations for their own business purposes, making it more operationally sound or effective, but still the insurance company is still recognizable. The second one is much more fragmentation with partners in the value chain. The insurance element may be part of a bigger package, may even be white labeled. There's no direct contact anymore between the insurance company and the policyholder. And the third is the most extreme one, where the big techs have taken over the insurance value chain. The GAFAs, as they were called at the time, I've recently learned that we now call them the tech fins, as opposed to fintechs, the tech fins. And so what will be the impact of that scenario? Looking at competitiveness of the market, the consumer choice, the interconnectedness, regulatory oversight. I hope you can see it over there to the right as well. Business model viability and capital requirements, conduct of business, and data ownership. I'm going to quickly run you through the main conclusions, but I guess it's worthwhile reading the report itself for the more granular details. But what the group found is that competitiveness is expected to reduce in the long term. Because of innovations, there may be a reduction in insurance companies in the market. Some of them may not be able to keep up with the innovations. They're more traditional, way too long, get marginalized. And certainly in scenario 3, if the big techs take over, then it will be even a further reduction. Consumer choice also expected to reduce in all scenarios, with more tailor-made and bespoke products being offered to customers based on what you do. The data is available and out there for you. It may be taken from Facebook accounts or wherever. Your behavior on the internet will get very tailor-made offers. That sort of removes the impetus to shop around. Those tailor-made products make it more difficult to compare. Already standardized products are difficult to compare, but it will even go a bit further if it's very much tailor-made. And we spoke about data this morning. Transferability has been identified as a possible barrier to consumer choice. Insurers may not be willing to quote if they don't have the proper data set. And it goes to show how important the discussion around ownership of data and transferability of data is. Interconnectedness. Well, typically that's a subject which we link to financial stability issues, the interconnectedness between firms in the market. This is a different type of interconnectedness. It has to do with the fact that only a small number of technical platforms are being used. And if something happens in that area, that's going to affect the entire industry. Also, the ability for regulatory oversight. In scenario 2, we see already more partners in the value chain, and they're not used to being supervised, so the culture around compliance, regulatory compliance, is different, potentially less. That will even be more the case under scenario 3. Business model viability and capital requirements. What the general thinking is that with the increased use of data, there's more risk will reduce. There's more risk awareness that can be acted upon, and but there are more extreme risks like the connectivity between and the interconnectiveness. The connectivity also about the reliance on IT systems. Conduct of business. So in scenarios where the insurance element is reduced, is not the main element of the whole product, then there is a risk of conflicts of interest. We already identify that as IAIS in mobile phone insurance with providers that sort of are not thinking first of all of the interest of the consumer, but of their own business interests, potentially, I should say. Moving on, data ownership, increase in risk of unauthorized access, use of transfer or personal data. I guess that goes pretty much, says it all here. Then there are other issues. This morning we already touched upon the affordability of insurance if that increases a risk of exclusion, but also new legal questions around peer-to-peer insurance. We've seen a presentation this morning which shows that they can have various shapes and forms, and depending on which one that is, there will be questions around are they supervised and as what, as a broker, as an insurer, or not at all. Are mutuals, is it a mutual, are mutuals being regulated in a specific jurisdiction or not? These are all legal questions around that. Blockchain may be combined with smart contracts, and smart contracts will trigger themselves. They are triggered automatically. That may prompt discussions around enforceability. More extreme is the case when a system is operation totally independently as an autonomous, decentralized organization. And then you have all sorts of jurisdictional competency questions. Who is supervising this if it's only existing on the internet? Continuing quickly, because I'm running out of time. So the conclusions, here we are ready. So fintech developments are potentially disruptive, and that's also the intention. It's not tuned towards inclusive insurance markets. It's not, the report is not for developing markets. It's general, and it's a way of waking up regulators and start taking note and perhaps go through the same routine of analyzing potential impact of what they see happening domestically, and they can fine-tune the elements they want to focus on. But we have noted that there is a need for insurance regulators, supervisors to be able to recognize that. That may mean they need dedicated staff looking at this as well, who are knowledgeable about this, and so that they can come up with the proper response. So that was the report, which was followed up with various other initiatives. I guess we'll be talking through that later, and then I can explain a bit more in detail what the follow-up of the IAIS has been to this. Thank you.
Thanks, Peter. Really interesting. I mean, like from the implication, it seems that regulatory oversight is really becoming more difficult in the future. Maybe just a follow-up question on the work that the IAIS is doing. How is the IAIS supporting insurance supervisors to really take that challenges?
Well, the various initiatives as a follow-up to this report. First of all, we noticed there's a whole range of issues we need to consider, but the decision was taken. Let's start with the basis. Let's start at looking what an algorithm is and can do. What are the potential? What's the potential? What are the challenges and the risks to that? Also, artificial intelligence and machine learning, very much from a technical perspective. And based on that knowledge and insight, then supervisors can take further steps in saying, okay, now I understand better, and this is what I can do. This is considering the fact that we represent a whole broad range of supervisors, and some are very advanced in their technical capabilities, but some are very much in a wait-and-see mode and taking a step back, but still need that knowledge that they can properly take care of the responsibilities. We're also going to look at in future work streams about digitalization, that affect the consumer protection, use of data, personal data, and a project we were already working on was the application paper on the use of digital technology in inclusive insurance, which very much came from the issues paper on product oversight, where the member said, well, we need support, we need guidance how to oversee mobile phone insurance and other forms of technical innovations. And that paper is almost finished. We just completed the public consultation to that, so we're going to go into the final stretch of completing that paper and getting it ready for adoption, hopefully in a month or two.
Thank you, Peter. And gets back to discuss the main issues a bit later in the discussion. Priya, fintechs are leading the banking side in India. Could you tell us about the InsurTech developments that are happening in India?
Good afternoon, everybody. Any introduction to the India landscape can't do without recapitulating a few numbers. So as you know, we are a very vast country, big country, with a population of over 1.2 billion people. And out of these, nearly 350 million people have access to the internet. Talk of information technology, our information technology industry is marching towards a $200 billion revenue size. As far as the insurance industry is concerned, it's over $80 billion. We have 57 insurance companies. And there is a study that says that by 2020, 75% of the insured people will have one thing or the other to do with online technology. So in this backdrop, let me very quickly cover the India perspective. So before I get into regulatory aspects, let me just briefly talk about what happens in India So let me try and give you the demand side and the supply side perspectives when it comes to the insurance industry in India. When I look at the supply side, I'm going to be talking about the insurers and the distributors, and the demand side, of course, the policyholders' perspective. And this is purely in the context of information technology and the role that it has to play in the insurance industry. So when one looks at the entire product life cycle, starting from the time that an individual is looking to get into an insurance contract or an insurance company is looking to sell a policy, information technology plays a major role in India, and the importance is recognized by the industry. So one can today talk of customer acquisition, use of technology for customer acquisition, use of technology for customer retention, use of technology for issuance of documents, use of technology for policyholder servicing, both in terms of modifications to the policy and also in terms of claim servicing. Of late, we have had this pattern of new insurance companies which have got registered, which have as their objective mainly the use of digital technology. So they are companies which are interested in looking at those kind of mass products which can be sold online. So the point that arises is what happens to the traditional insurers? And from the consumer point of view, is there going to be a group of people that's going to be excluded? Because when you look at a country like India and you look at the masses, yes, I did talk about the number of people who have access to internet, but are they really IT savvy? What is the quality of these connections? When you look at remote areas, you're not even sure whether it can work perfectly. So we have basically a paradoxical situation. But then one good thing is that the traditional insurers too have not been left far behind when it comes to technology. In particular, I'd like to mention that the government companies, which are very, very huge, which have thousands of branches all over the country, too have made good strides when it comes to information technology. The regulator is quite conscious of the challenges that they face, but the insurance companies have made it a point to invest in technology, keeping in view the long-term thing, and the regulator has tried to facilitate this even while ensuring that the interests of policyholders are not compromised. Distribution, yeah, it increases transparency, speed, efficiency, we all know that. But what is in it for the consumer? For the consumer, there's certainly a differential pricing involved because economies of scale do work here, and probably the policyholder gets the product for a lower price. From the demand side, we have been talking about, robo-advice this morning. I think Peter mentioned it. So you have technology playing an important role. But when we talk of robo-advice, we're also looking at basically, artificial intelligence, rules-based thing that we're. So how the rules are built is, I think, very important. Technology is always available. But it is the domain part, what we build into technology, I think is very important. Today, consumers have comparators, product comparators, because there's a lot of choice. They also have premium calculators. An interesting development here in India is that we have the concept of web aggregators. So they are entities who are not insurers, they are not distributors, but they basically compare products. They have websites which compare products, which helps the policyholder make a choice. Policyholder servicing, tremendous strides in the industry. Most of the companies have their own applications and processes and modules. You heard the young boy talk about what he is doing. So we have several such entrepreneurs, many companies, and all insurance companies give a lot of importance to IT. And this is also one of the important things we look at when an insurance company applies to register with us. Well, when it comes to technology per se, the FinTech paper also basically covers a lot of that. We're talking about big data, artificial intelligence, Internet of Things, wearables, portables. So these are all things the insurance industry in India is looking at. Let me quickly cover the regulatory perspective. I think I'd like to mention some of the important initiatives that the IRDAI in India has taken. One is the creation of insurance repositories. We have developed a framework around creation of insurance repositories. These are basically repositories where customers can hold their insurance policies in e-form. So you can have a customer who's holding 5 or 6 policies, have one account and hold it in e-form. So these also enable modifications to the policies and at the point of claim also. And in fact, this really helps the family in the event of the death of the insured person. We have framework around e-commerce. We have issued guidelines for e-commerce. Insurers do use digital platforms, and we expect the insurers to register that with us, not for anything, not seek any approval, but just to ensure that their obligations toward policyholders like disclosures and things are taken care of. So I mean, this would broadly summarize. I'm sorry, what happened was there's a mix-up with the presentation, but broadly what I want to tell you was that in the regulator in India is currently looking at balancing innovation at the same time. One last line, we've been talking, I've seen the tweet about 150 kilometers versus 30 kilometers. 150 kilometers is bad, leads to accidents. 30 kilometers is also bad, leads to accidents. The reality is somewhere in between, and you need those speed breakers, you need those traffic lights, you need the red, amber, but there's always the green, and you do finally motor on the roads and reach home. A quick point about the Insurance Information Bureau of India. That is the organization promoted by the regulator and the government. That is a huge repository of industry level data that is collected. It's a summary of, it's a, compendium of transaction level data from the industry, and that has lent to a lot of data mining efforts. With this, I'd like to thank you.
Thank you, Priya. That was very interesting. Just one follow-up question to you, like from your perspective as an insurance supervisor, how do you see the value to really low-income clients of the newer insurtech innovations that are taking place?
Right. At the outset, any investment in information technology is going to be expensive until you get to critical mass. You need to get those numbers. But in the long run, as I mentioned already, definitely it's going to see a lowering of price. And two, while we do have a challenge of reaching out to the rural areas, because most of our population is in the rural areas, there are, technological innovations, I would say, that have been made where people are reaching out. For instance, let's say, talk of collection of premium. So you do have, in the banking, we have the concept of business correspondence. They have a small handheld machine which goes and collects the deposits. Similarly, we have handheld devices where people can actually, the premium, the receipts are generated on the spot. We have what they call one-man offices, which is very technology enabled. There's only one person manning those offices, but it's all technology enabled and connected to the branches. So in that sense, I would say that it would increase penetration tremendously. And with the economies of scale working, it will certainly bring down the cost.
Thank you. Let's discuss a bit more in detail later. Sabahat, I know that the Securities and Exchange Commission of Pakistan has recently issued directives on technology-based distribution channels. Could you give us an overview about what the regulation covers and why you took that step to issue that directive?
Thank you, Stephanie. I would like to give a short presentation on that. Well, there have been certain technological developments in Pakistan in respect of insurance and since quite some time, and there had been mixed response from the insurance industry. There are certain companies which are ready to innovate and which are the pioneers in the technological advancements, but there are certain companies which are rather conservative in their approach and which would rather want to stick to their conventional style of selling insurance and would rely on rather direct sales force. Currently, there are few modes of technological distribution channels, which are SMS-based distribution, telesales, insurers' own websites and web aggregators, and the payments are made through either mobile money, mobile wallet accounts, which are the branchless banking accounts, or the digital banking account, whatever name you may call it, or the banking account as well. If the sale activity is being conducted through the bank's call center, then the deduction is made through the bank account of the policyholder. And if the sale activity is being made through the broker's call center, which is a dedicated call center being set up for selling insurance, then the possible mode of premium deduction is deduction of airtime from prepaid mobile balance of the policyholder. In case of insurer's own website, in case when insurance is sold through insurer's own website, then premium may be deducted, premium may be paid through debit card or credit card, and in case of web aggregators, a debit card or credit card may be used for premium payment. Like my colleague said that in India, web aggregators are not the distributors, but in Pakistan we have seen the examples where aggregators are being used as distributor as well, particularly in the case of travel insurance, because premium is being paid online through debit or credit card, and policy is issued right there and then. But in case of auto insurance, the survey is done and the referral is being made to the non-life insurance agent, and the agent visits the car and conducts the survey of the car, and then policy is issued after the physical inspection of the car. And same is the case with health and life. Insurance technology is being used in other areas as well. Like we know that insurance technology is being used for promotions, for customer engagement, for communication, for just like on social media you can get personalized messages. On YouTube you can get personalized messages. On the basis of videos that you have viewed, you can get those kind of video recommendations. So similarly, you can get personalized messages, and on social media you can get the reminders. So these are also some of the facets of the insurance technology. And in Pakistan, we have recently approved certain life insurance products. In Pakistan, we have a file and use procedure for the life insurance products, which means that life insurance products are filed with the regulator, and if you don't respond within the 30 days of the filing of that product, it means that insurer is free to launch that product in the market. So through that file and use procedure, certain products are being filed with us, in which certain wearable technological devices are being used by the insurers to track the health performance of the policyholders, and on the basis of good performance of policyholders, on the basis of showing good performance on those health indicators, they get reward points which can be redeemed through discounts or through reduced premiums or through reimbursement in the policyholder investment accounts or through such other manner. And we have recently also approved one product in Pakistan which is an example of on-demand or hour-based insurance coverage, which means that the policyholder has the option to turn the insurance on whenever he likes, and he can avail it on the basis of on the basis of how many hours he wants to have it, and he can switch it off whenever he wants. And in case he forgets to turn it off, it will automatically be turned off after 24 hours. And we also have a centralized information sharing solution for insurance industry, through which insurance companies can share information among themselves regarding certain aspects such as group life claims experience, declined or postponed risks, life insurance agents, and insurance involved in codified misconduct, and also the group health insurance claims experience. We also have crop loan insurance scheme in Pakistan, which was launched back in 2008, and in that scheme, claims are paid on the basis of crop yield. Say, for example, if a calamity is hit, there are dual triggers for payment of claims in that scheme. First is declaration of calamity by the government in a particular area, and the second is that it is declared that the crop yield in a particular area is 50% lesser than the reference yield in that particular area, and it is authenticated by the Space and Upper Atmosphere Research Organization, which is SUPARCO, which is called SUPARCO in Pakistan. So this is also technology facilitated scheme. About the directive that we have recently issued, the title of the directive is Directive for Corporate Insurance Agents and Technology-Based Distribution Channels. We have recently issued it in December 2017, and it would be effective for all the new business issued on or after March 31, 2018. So it is yet to become effective. And few of the elements which were important for us to include in that directive were the client value risk. We were really concerned about the fact that sometimes people do have access to insurance, but maybe that access is so not so useful for them. So access is important, but the utility of that insurance is also important. I can share one example in Pakistan that one of the insurer shared it in an informal setting with somebody else, and I overheard it. Sorry for eavesdropping, I sometimes do that. I heard him saying that I make easy money out of a personal accident product. I set up a call center, I make a pitch over the phone, I deduct the premium after taking the consent over the call, and claim never comes. So I'm very happy it's easy money. So it's not that only access is not important, utility is also important. I'm not saying that nobody should sell personal accident product. Personal accident product should be sold, but utility should also be there. Customer should be totally aware that he has that product and what's the utility of that product and how and when to use that product, and in case that claim arises, when and where and how to make the claim. So client value risk was really important, and we have included in that directive that file and use procedure will be applicable in case of life insurance, in which the life insurer will make it clear to us that how he will communicate all the terms and conditions to the policyholder. And in case of non-life insurer, we have put the onus on the insurer that he will communicate all the terms and conditions to the policyholder. And we will monitor it through the inspections or whatsoever our regulatory processes are. The other aspect is distribution channel risk, and which means that there should be appropriate manner of exiting the distribution arrangement, since multiple parties are involved in the distribution arrangement, which may include the TPA, the broker, and the agent or the MNO. There should be clarity of roles and responsibilities due to multiple parties and involvement. Data safety and ownership was one concern, and there is also commission clawback clause in that directive, and there is semi-annual product-wise reporting, which is also required by the directive and which would become effective after March 31st, 2018. Thank you very much. I had to comply with the time limit.
Thank you, Sabahat. Yeah, we can discuss a bit more detail later. Arup, you are active in so many countries in Asia, so I think you will also have an overview about what's happening in other Asian countries. We heard from India and from Pakistan now. Could you share a bit with us what you are aware of, like how supervisors in other Asian countries are supporting InsurTech, and also like to share from your side what is really key, like how should a regulator now go about it? Should he start writing a new regulation on it? Should he be like first wait and see approach? What is your recommendation?
Well, thank you, Stephanie, and thank you all the panelists for very interesting insights into how things are happening. And you want me to talk about how things are happening and how things should happen also. But before I start, let me also react to the first remark you made in your opening, that the fintech operators or the insurtech operators are running at 150 kilometers and regulators are at 30 kilometers. That reminds me of an African proverb which says that if you want to walk fast, walk alone. If you want to walk far, go together. And we are in a workshop of inclusive insurance, and therefore we have to, I'm not saying we have to stop walking, but we have to continue to walk and increase the pace of our walking, but possibly we can, once we are comfortable, once we have done our conditioning, we can then start running. So that also is very, very evident that the fintech industry is not carrying out the desired level of consultation with other players in the ecosystem. And whenever this thing happens, there is this phenomena of excess profits, until the market learns from the experience and profit levels become more normal as it should happen in a perfect competition. So there is inequality in the system, and the regulator's job is to ensure that there is competition, number one. And after that, they have to see whether products are affordable and the policyholder is getting a fair deal, while ensuring that the entities they regulate, they also remain stable. Coming to issues of related to fintech in other countries, of course, I also work in Pakistan, not much in India. There have been a lot of changes happening, and the pace of change also determines how fast or how soon the regulator needs to respond. If there are not many disruptive changes happening, the regulator can adopt a wait and watch approach. But if the speed of change is very, very fast, they have to definitely look into ways in which the consultation process is enhanced, and they come up with systems which don't impede innovation in that sense. So, and regulators have been doing that for quite some time. It's not that because of fintech, which is the new buzzword today, that is happening. When I was working in India, we were using pilots, test and learn approaches. Philippines has been using that also. In fact, they introduced Gcash even before what you call M-Pesa in Kenya. But M-Pesa was able to scale up, whereas in this case the experiment was not that successful. But the regulators' blessings were always there. And as a result of that, in India, the first pilot was the parametric crop insurance scheme, which got scaled up and now is mentioned as a successful experiment, which really could be not only replicated, but also scaled up in other countries. So these are the examples. Coming very specifically to RegTech, I think the examples which were mentioned about regulatory sandboxes, the test and learn or whatever, or pilots, by whatever name you call it, I think that is one of the answers for regulators to understand the risk, to regulators to calibrate the risk, and also in terms of, from a consumer standpoint, the consumers also understand the utility of that product, During that process, what happens, you also get a cue from the distribution channels in terms of excess commission, in terms of some overriding charges which the distributor may charge. Say if the product becomes popular, the distributor will say, well, if you want this product, the regulator has this cap, but you'll have to still pay something up beyond that. Now, where technology helps here is if you have a smart contract like blockchain and all, it ensures that things are transparent. It also introduced the trust. The trust was something which was talked in all the sessions, the lack of trust. I think to reinforce trust, smart contracts, blockchain, etc., becomes very, very useful. And I like something which Singapore, UK, and Australia have done in terms of not only setting up sandboxes, but they also mutually recognize the experiments which are happening in their territories. So if the regulator gives a green light to a sandbox, say in Singapore, then they don't have to start another sandbox in UK to even replicate. So this mutual recognition is there. So for economies which are running, which have to comply with time limits, like all of us here, And the aspirations are that the regulator should act fast. This type of mutual recognition, especially for multinationals who operate in different locations, that might be a good idea.
Thank you. And maybe just a question on the sandbox. Could you just quickly explain? It has been mentioned before. I'm not sure if everybody is aware about the sandbox approach. Could you just quickly explain? And also, is sandbox really applicable in all countries? Do all countries have the chance to work on products before they issue a regulation?
Well, if you see any insurance law, the regulator or the government generally have an overriding power. There is some clause in the act somewhere which says that the government can still exempt, or the regulator can still exempt certain businesses, certain distribution channels temporarily, in public interest. So I think that clause, in most of the laws you will find that exemption. So you really don't have to craft a new law that in that sense. One can make use of that provision and start piloting. And that's what we exactly did in India. We also didn't have a regulatory sandbox or even any provision in the law which says that pilots would be allowed. But there was a provision in the act those days that the government could exempt an insurer from certain regulations and all. So that is for the regulators to decide, but generally that enabling provision is there in all laws. Coming to the sandbox, basically the regulator also needs to have a clear understanding of the risk, because they are ultimately responsible to correlate the risk with the solvency of the company. And I was also mentioning in my remarks that most of the discussion is around market conduct and governance and very little on prudential. And the regulator's job is to ensure that the claims paying ability of the company is not compromised by introducing innovation. And that's why they are overcautious, And if they have a better understanding of the data can be captured better, can be analyzed better, definitely there is something which the regulators, I have not found them that they don't want to encourage such systems, but they really want to have their handle on how those risks amplify as these pilots or as these innovations scale up. And that is something which is very, very important. Coming to how sandboxes can be encouraged, well, there are different models that way. Somewhere the government, the regulator, the industry, they all participate. It's more of a controlled environment, but it is real time also at the same time. So that means so there is it is not a simulated experiment. It is a controlled experiment where there is an equal chance of profit and loss. And regulators are in touch on a day-to-day basis. So that way the skill levels of the regulators are also built, because they understand how to calculate the risk, how to understand the risk. Their interaction with the industry also is enhanced. The regulator cannot be a know-all, because this is an area like IT and say even in the case of health insurance, different medical procedures and all. Financial sector regulator also has to work within his or her perimeter. So in these types of experiments, what happens is they are able to ask the right question. If you ask the right question, there is a possibility of you getting the right answer. If you don't ask the right question, you'll never get the right answer.
Thank you, Arup. I have a full list of questions, but maybe this would be a good point to open for questions from the audience. So maybe we do a quick round of 10, 15 minutes. Oh, there, the hand's going up. to give the audience the possibility to ask questions. And maybe I suggest we collect like 2-3 questions and then.
Thank you very much. My name is Yoga from Allianz Indonesia. Talking about digitalization and also the use of technology, I was quite surprising realizing that not only Indonesia but some other jurisdictions are also still don't have regulation on the e-policy or e-contract. My question is, what the lesson that we can learn from India or IRDA to make the other countries adopt that? For instance, prior to have the e-policy regulation, what is the biggest potential issues that are afraid to be faced off, and how India or maybe other country that already implement this regulation deal with that? Thank you very much.
Hi, I'm Ankita from Apt Associates India. So right now, at least in India, the digital platforms are very much prevalent in the insurance sector, and they are pretty much regulation friendly. So my question is, if we go ahead with the blockchain technology within the insurance, what would be the regulatory concerns which, as a regulator, you are afraid of?
Dante Portula from GIZ. The insurance value chain has many other players. Look at the government side. We have other ministries, Ministry of Finance, Ministry of Agriculture, if it is in the agribusiness value chain, and you have communication now with MNOs. And my question is, in terms of interagency cooperation, bringing these different players in the regulatory side, who do you think should lead in this coordination, cooperation among different government agencies? Would it be the insurance regulator? Would it be ministry? Or would it be the work of Congress?
So if I've understood you correctly, what was the trigger to come out with a framework on e-commerce? So what we found was it's not the intention of the regulator to get into drill down operational details, but what we did find was that it gave a lot of scope for mis-selling and lack of disclosure on the part of companies when they were resorting to technology-based methods of sale. So starting with, in fact, my colleague here was talking about sales pitch through distance calling. So we began actually with a framework for distance calling when it came to sales. And then when the mobile thing caught up and online caught up as well, we came out with a comprehensive set of framework that basically put obligations on the insurance companies. One, to ensure that certain minimum information is collected before an insurance policy is sold. Number two, to ensure that simple products are basically sold online. And third is to ensure that proper disclosures are made by the insurance companies so that the policyholders or prospects can make an informed choice. So that is what triggered, and we find that it's, we are quite happy that we came out with a framework because the complaints in respect of online sales have come down. The second question was also related to the digital platforms and what would be our concerns. So I would repeat that, the idea of having the e-commerce guidelines and having the insurance companies and the intermediaries to register with us the fact that they have a self-networking platform is again not to interfere in the details of what they do, but more from the point of view of confidentiality of information, protection of the company's functioning, which also includes the policyholders' data against cyber attacks. So at a broad level, we have certain guidelines for cybersecurity. Simultaneously, from the policyholder interest point of view, we have regulations. So at a macro level, the insurance companies, do have to make sure that keeping in interest the policyholders' data and their vulnerabilities, there is a certain framework.
And maybe on the third question, also to others, Peter or Roop, maybe, like who should lead the interagency cooperation? And
yes, well, what we see generally, if you look at the business value chain between the customer and the insurance company, certainly in the fragmentation, a lot of third parties being involved. But I guess Dante's question also related to cooperation between public authorities in the whole debate and the whole context of microinsurance or technology. So yeah, I guess everyone has its own role to play in that whole discussion, and what we see as IAIS, that sort of the supervisor needs to be a dedicated supervisor, dedicated to its mandate, policyholder protection, sustainability of the insurance industry, and financial stability issues, and that cannot really be diluted by other considerations, although they very often have a mandate in market development, etc. So everyone has his own role to play. If it comes to keeping a sound and safe business environment in the insurance industry, we think the insurance supervisor is in a key position to play a role in that respect and engage other authorities where needed. Sometimes if you see that the regulatory framework is not adequate, for instance, to allow innovations to take place, we expect the insurance supervisor to raise this at an appropriate level, whatever that is. So it's sort of the spider in the web type of thing, to get involved those institutions they think need to be involved, be it the regulator, policy maker, the legislator, or other institutions as well. It's of course in a unique position to see what's happening in the insurance industry and respond to that as early as possible. It sees data from the insurance industry. It's engaging with industry representatives, also by consumer representatives. So it's also a key information position. So I think it's a likely candidate. I'm not going to tell you, because that's very much domestically decided, but I think they have a good case to make, to say, well, let us be the initiator of those contacts between and engagement between all those involved.
Yeah, just to quickly add, I agree with Peter that it is not a one-size-fits-all solution. It depends on what type of solution you are working on. Stability issues, generally there are coordinating committees of regulators where all the sectoral regulators participate. So that might be a good area, a good platform to discuss if things pertain to financial stability. If it is on financial inclusion, maybe some other interagency coordination body. Generally there is not one. So maybe to implement a financial inclusion strategy, there might be some other agency. So that agency possibly might look into. I'll just quote one example here. One of the challenges we see is in terms of interacting with insurance regulators in particular, is they tend to take a very narrow view of things. They don't think beyond insurance for good or bad reasons, but in the access space, access to finance space, of course, and that is true for many of the insurance players also. I don't want to blame only the insurance regulators. So one purpose of insurance is protection of assets, lives, and all, income and everything. And that is what was explained, where fintech can play a role in the presentations in the first session. But insurance can also be used as a tool to access finance. And that's where we need to understand how the banking sector operates. So linking insurance and banking definitely is very important. Most of the times, insurance innovations piggyback what's happened in banking. And the third area where we can really take advantage of the data and all is in terms of understanding the risk and also understand what type of risk can be transferred through insurance mechanisms. There can be some risks which can be shared through a guarantee mechanism or something like that. Then some risks can be transferred. So insurance can be also used as a tool to access finance, being used as a collateral, but it can also be used to de-risk projects and make some sort of, if I use it very, very loosely, making an unbankable project bankable possibly, by bringing in other blended financing. And in all these areas, technology has a very important role to play, to basically, again, boiling down to understand the risk better.
Thank you. Before we ask more questions, maybe I want to take up an issue that was coming up in the first session on the new data analytics that are taking place and the role of the artificial intelligence. Like, to all of you, what do you think about these developments? First, will this increase customer segmentation that will be possible? What effect will that have on the low-income population? Would that mean that they are priced out of the market? What's your view on that? And then the second angle that would interest me is the data protection angle. So I think people are quite open to give away their data away quite quickly without understanding the implications of it. So how do you see that?
I'm giving my personal viewpoint. This is not a ADB viewpoint in any way, but definitely something which was also discussed in the previous session. In case that there is an unintended consequence, I would say that. So inclusion can lead to exclusion if data privacy things, data privacy related regulations are not put in place. And that is what Peter also mentioned when he responded to that question in the previous session. In terms of data privacy, very big issue. I was in Kathmandu last week and I was in inside the control tower where the US South Pacific Command was giving a presentation on disaster risk management. And we were just into the presentation when the crash happened, and we were immediately told, we shifted out, and it was just 100 meters away, so maybe God's grace I'm still here, It could have, because the plane was wavering, that's what the eyewitness said, it could have hit that building. Somehow the pilot swerved the plane back towards the runway. But anyway, that's a different story. But when I came back to my hotel and my phone was switched off, Facebook says that do you want to be marked safe? And I just clicked that, But Facebook got that data. So in terms of privacy, that's a very important issue. So a lot of these institutions which will be involved in collecting data, they will be also monetizing the data, even if it is in aggregate form. So will that benefit translate in some way in terms of lower premiums for the customer? I doubt, because what I heard in the previous session is the fintech operators say that they have to spend a lot of money for R&D and they have to recover some way. So those are areas exactly where regulatory intervention becomes very, very important. And I think I should stop here and let hear others.
So, talking of artificial intelligence and how it can really help, and can it be an advantage or a disadvantage, I would say that amongst all the financial service products, services, insurance is the most complicated. Even if you're looking at a mass product, it's not very easy to build rules around them. I think I mentioned it earlier. So technology is fine. Technology can always be sought, but how competent are we, and how much data do we have to build the required rules around it? I do agree that artificial intelligence can play a big role in fraud detection, because you would be able to detect outliers and basically probe further into it to understand. But today morning the young boy was talking about artificial intelligence, giving advice, artificial intelligence, admitting claims. I'm a bit circumspect on that, because let me give a very simple example of a claim under health insurance. So you're looking at a claim that is paid, let's say for hysterectomy. And in the same geography, perhaps even in the same hospital, even at the hands of the same doctor, and same age profile, the claims outgo could be very different, because it would depend on the health condition of the person and the complications that could be there. So I'm just trying to understand, how good an idea it would be to build rules and reject a claim saying that it is, probably too expensive or too costly a claim. But then I'm trying to play the devil's advocate, because I keep in mind as a regulator the policyholder's interest. It doesn't mean that we shouldn't facilitate artificial intelligence. So that is one point of view. Coming to data privacy and confidentiality, I do agree that it's extremely important to ensure that policyholder data is kept confidential, and it's the duty of the regulator to ensure that there are rules built around that. Not only do we have to build the rules, I think what is important is to ensure that they are implemented. So that is definitely a concern. Yeah, you'd like to?
I think our data is being tracked from everywhere, from almost everything we do. Even if we don't use any app, if we have Android phone, Google Assistant will catch every voice that we every word that we say, everything that we speak. And if we have iPhone, Siri catches everything, every word that we speak. And Google search, the Chrome catches every search that we do. The YouTube catches every search, every video that we watch, every search that we make. So I don't think it is only responsibility of only the insurance regulator, or it revolves only around around the field of insurance to protect the privacy of people. It's far beyond the domain of insurance, I guess. And I am really not sure that to what extent it goes ahead.
Maybe to add a few considerations on both subjects, I guess. Artificial intelligence, so we've seen that it brings a lot of new things, a lot of benefits. It can see causal relationships that were not seen before and bring benefits. We've seen that in medical science, for instance, where it brought cures, or at least brought on the right path towards a cure. I guess it's for the insurance industry, it revolves around basically the algorithm that you use, and if that algorithm leads to proper customer outcomes, and if the customer is treated fairly, and that's there's a challenge for the supervisor. It's a challenge in design for the insurance firm, but for the supervisor to see that, and there are various ways of dealing with that. If you consider it the black box or not, but that's it can bring benefits, but it's about what you use it for. And in terms of pricing, for instance, that sort of further customization, breaking down the customers in more refined, granular cohorts, that can be useful for risk management purposes, can be useful for solvency purposes, but the question is, do you want to use it for pricing? So it's very much, you can make it do anything, but what do you want to use it for? There's some considerations on the artificial intelligence. On data protection, yes, well, I think there are two sides to this. The first side is about data and data availability, and I think the European Union is moving towards free movement of data as an important element. That and we've seen startups developing and wanting to become an insurance firm are challenged by not having the right data. They have a great app and a great solution for which the consumer can benefit. But there are regular challenges, but there are also challenges in the way of the data, to get to the data. So opening up that market is, from that perspective, important. On the other hand, there are privacy concerns. The use of data, who owns the data, very much something that needs to be resolved in a regulatory framework. We've seen that informed consent is very critical in that whole debate. To what extent have you given permission to use that? But on one hand, we as IAIS, we have produced a paper on the product oversight and inclusive insurance, where we say keep it simple. But if you then use that policy on your smartphone, then you need to accept terms of references that are 60 pages long sometimes. So there's a bit of discrepancy there, and you can't read it very well on your smartphone, and before that you give consent to something which you may not even have read, regardless if you're in the developed or in a developing economy. So that's something that needs to be thought through, I guess, and probably there will be a lot of things happening, a lot of discussion, debate happening, and at some point the solution will need to be found by all the users in how to find the right balance between the use of that data for the benefit of all and still giving an adequate level of protection.
Thanks, Peter. Back to the audience. Are there any more questions or reactions to that?
Good afternoon. I'm Ali from EFU Life Pakistan. I just wanted to probe a bit more into the insurance repository that you spoke about. Now, from what I understand, for a repository to work, you need the customers to have internet access, and you need them to be to have internet literacy of a certain level to create an account and then maintain the account. Now, obviously, in a country like India and also in Pakistan, we have significant insurance, especially life insurance business, which is from the rural areas and also from the lower income group, where we can assume they don't have internet access or they don't have the internet literacy to create those online accounts and then watch, the progress of their policies. So, keeping that in view, how has been your experience over the last couple of years? Do you see more and more customers opting for the repository? Because from what I understand, it's not compulsory. If someone wants a paper document to be delivered, that is also an option. So I just wanted to take your feedback on that. Thank you.
Actually, my question to Mr. Peter, actually. Half of the question relates with this seminar and half with other topic, actually. But you know that as a regulator, we had primarily three main objectives. I'm basically from Pakistani regulator, in Lahore, my name. Basically, we monitor the consumer protection, we ensure consumer protection, also the market development. So we try to observe the different trends which affect these areas actually. Fintech is obviously one of those areas. But another area is that IFRS 17, which is basically going to significantly change the life insurance industry and the non-life insurance industry as well. And this IFRS 17 also has strategic implications. We see it as that IFRS 17 will reinforce the unbundling in the life insurance. So is there any project under the IAIS which can address the interaction between these two things, the fintech and IFRS 17?
Yeah, so I'll start with the last bit first. I think that was, I should have mentioned that. So you asked whether it's not mandatory, right, is what you said. So basically, as per our guidelines, there are certain policies that need to be mandatorily issued, through electronic mode. And these are set differently for life insurance, health insurance, and motor insurance, and depends on the sum insured and the premium. But the next question is, is everybody complying with that? The answer is no. There is some regulatory forbearance because of all the details that you mentioned, the kind of profile that we have and the connectivity problems. But what we find is that the compliance has been improving. So when it comes to the repositories per se, I must mention that we have 4 approved repositories in the country, which are approved by the IRDA. And the biggest achievement, I would say, is that though this started about 5 years ago, in the recent past, we got the Life Insurance Corporation of India, which is the largest insurer in India, on board. So you do have, in the life insurance space, you have many companies which are complying pretty well. But yeah, when you look at the customer, it is one who has internet access, and second, one who can open an e-insurance account with the repository. But as far as the experience goes, it is getting better each year. And so we really want to make sure that we move forward with this. As I mentioned, end of the day, we do expect that costs will reduce as the numbers accessing the net expand, and technologically also we're really improving even when it comes to connectivity.
Maybe Peter, just quickly on the IFRS, which is quite technical.
Which is quite technical, and the answer is simple, that there's no specific project for the IAIS planned on that relationship between IFRS and fintech. But not to send you away with this simple no. We're looking at fintech. We've started with a strategic approach. We're now picking up on what is the next step, very much from the basic. Let's first have a look at what we're talking about, and then identify any subsequent issues that emerge. I'm not sure if this will happen, but after the first step on the identification of algorithms, how does it work, artificial intelligence, we may look at more other areas. One of them is about third-party involvement, third-party reliability, things like that. So I'm not excluding it, but currently I'm not aware of any plans for that.
Thank you. So let me ask one final question, and whoever wants to answer that. I think really with the low-income clients, like really this face-to-face element is so important. And with this new digital technologies coming up, and also you see that with mobile insurance, that gets a bit lost or less if you don't have agents in place. What do you think about this? Like, how can the supervisor then ensure that that people understand the products, or is that making it even harder now?
I must mention that online and technological advancements are not at the cost of excluding the face-to-face mode. In fact, one thing we are encouraging is for the agents and the other intermediaries themselves to basically resort to technology and interface with the insurance companies. So you have a customer actually approaching an agent, but you have the agent accessing the insurance company's portal to get that insurance done on behalf of the customer. So the idea here is to increases transparency and also increases efficiency and speed in delivering the service. So both have to work together. And we are also coming out with new ideas. For instance, we have the common service centers. They are basically centers which are set up by the Government of India for various other information IT services. But these are, we are pigging back, the industry is pigging back on that to basically sell insurance policies. So what happens is a person in a rural area can actually go to this center in the village, and you have an individual sitting there who, apart from helping him pay his bills and other things, can also access the insurance company's website and sit with him, fill up the proposal form, make sure he understands, explain it to him. So there are methodologies where we are parallelly trying to ensure that people get familiar with the idea of technology.
I will just supplement Priya by giving an example to make things clear. I like to quote examples and where I've personally experienced. And back in India, so I wanted to buy a travel insurance policy for one of my relatives who was accompanying me to Manila. So I called the insurance company, they sent an agent, the agent came with a laptop, and he had web access, not Wi-Fi access from my home, but he had mobile access that way, to the mobile internet access. He connected to the internet, fed all the information which he wanted. Then through the web, the premium, the actual premium cost was calculated. Then he asked for my credit card number, which I gave to him. The transaction was made. Naturally, when the credit card number was given, an SMS came to my phone to authorize the payment, and which I authorized, and immediately the policy, once the payment was accepted, the policy was generated and it came to my email account, So I didn't have a printout of the policy, but the PDF version of the policy, receipt, everything was there. Just like what you do in the case of buying an airline ticket, So those types of things are happening. In terms of what Stephanie was mentioning, a lot of these countries in Asia have a very young population, so I'm very, very hopeful that because of the demographic dividend which these countries enjoy, the uptake of fintech products, insurtech products will be much more than the rest of the world in this part. There is also a problem of elderly population, so therefore we need to keep an alternative ready for them, just in case they would like to use that second alternative.
I have another example to offer. Well, we're giving examples, but maybe to start off first, that direct contact is as good as long as it's helpful in having the customer understand the product, and as long as there is a suitable product being sold to, it can be done through direct contact or by any other means. And what I've heard as anecdotal, or not, in other words as hearsay, is that in the area of RegTech, so the compliance innovations at the level of financial firms, does allow that call centers that call people to sell insurance are being tracked through voice recognition analysis systems that can even measure the distress levels in people's voices, whether or not they understand that, and that can be led to a direct intervention from the compliance department contacting the operator to explain where things are going wrong and where additional information needs to be given. So technology can be a very useful aid as well. But as I said, whatever means, the end result, the outcome of that should still be a fair treatment of customer in terms of a suitable product and a good understanding of that product by the customer.
Just a small clarification of my example.
Another example?
No example. That's my own example, that same example. So this person was 85 years old, so normally on the internet you couldn't purchase, he was not eligible to purchase a overseas travel policy, so a face-to-face contact was important. Otherwise, this is not necessary if there are some assistants like me to assist them.
Thank you. I think we need to close now, but we will have the chance in the breakout groups to discuss the different InsurTech applications in more detail. So with that, let me thank my panelists for the really interesting inputs that you provided, and thanks also to the audience, to the interesting questions.